It should be obvious to you that banks don't want to lose money. So before they make any type of loan, banks perform an analysis to determine if the borrower will be able to repay the loan plus interest. This analysis is performed by a bank employee called a credit analyst. So if a credit analyst is trying to decide if she wants to issue a loan to a student, and if so, for how much, then what criteria is she looking for? First, she's going to review the student's history of paying back debt by checking the student's credit score. This credit score captures things like 1, the student's payment history, meaning if they paid their bills on time or not. 2, types of credit they've used, such as a credit card versus a car loan. And 3, the amount of credit they've used. If the student doesn't have a credit score or has a low score, then the credit analyst might deny the loan. After reviewing a student's credit score, the analyst looks at the student's ability to repay the loan based on income from their jobs after college. For example, the credit analyst will probably be willing to loan more money to a student majoring in engineering at a top college versus someone who attends a lower ranked college majoring in English. This is because, in theory, the engineer will make more money after college that can be used to repay the loan than the English major will. So now that we understand the process private lenders use to determine who gets a student loan, let's talk about the impacts of this process. First, I recognize that it might be harder for students to get loans right out of high school because they might not have enough of a credit score to appease banks. 2 solutions here. First, I actually don't think it's a bad idea to delay starting college until sometime after you're 18. If you start college at 20, then that gives you 2 years to build up your credit score. Second, and most importantly, I don't think lenders should even consider credit scores in the first place when making student loan decisions. Instead, these decisions should be based solely on a student's future earning potential. This earning potential is a function of a student's college, program, major, and scores. This is already happening on a smaller scale because some private lenders currently issue loans to students who don't have either a credit score or a cosigner. Following through with this idea, I recognize that banks will not offer the same amount of loans to each student. For example, I think banks will lend more money to students at colleges with better employment outcomes and in majors that support higher salaries. Honestly, I think this is a good thing. First, you know that I firmly believe that the mission of college is career development, so it makes sense to me to reward schools with the best employment outcomes and to punish schools with bad employment outcomes. Second, banks will require that colleges publish detailed employment and salary data because the banks need that data for their loan analysis. If a college's data is incomplete or unsatisfactory to the banks, then prospective students won't get any loan money to go there. This might force colleges to produce even better employment data than they currently do, and that can, in turn, help students make better college and career decisions. I want to end with a few notes. First, it would be incorrect to say that what I'm suggesting will stop students from majoring in what they want. That's not true. You're obviously free to choose whatever college you want and to study whatever major you want. The only difference is you might not be able to borrow money to do so. But that doesn't have to stop you. You can always use your own savings to pay tuition, or maybe if you're lucky, someone else will pay for it, just not a bank. And in earlier videos, I proposed changes that would make college much shorter and cheaper than it currently is. So if those changes were made, then you'd need less savings or loans to pay for school anyway. Second, there are some majors leading to jobs that provide an important societal benefit, but the pay for those jobs isn't very high. For example, teachers and social workers. Teachers and social workers are absolutely some of the most vital members of our community, but unfortunately, those jobs don't pay nearly what their societal benefit is. I don't think a bank is going to lend an education or social work major a lot of money for student loans, but even if the bank did, that would be a bad idea for students to take that money. But would this impact the number of people who study those majors? I hope not, for a couple reasons. First, It might work out that tuition freezes or even starts decreasing for majors where students cannot access higher amounts of loan money. And second, these majors are great examples of areas where state governments should subsidize tuition. Many states already do this to some extent, but in my example, I would want the state to pay the undergrad tuition and fees of social workers who attend in-state public colleges if certain conditions are met. In exchange for getting their school paid for, the social workers must promise to provide social work services within the state for 5 years after graduation. If the social workers don't want to work in-state, then no big deal. They just won't get their tuition paid for by the state government. And finally, the federal government has been pushing 2 ways that colleges could bear the financial responsibility if high rates of their students can't repay their loans. First, students at colleges with high default rates might lose access to future federal grants and loans. And second, colleges might be forced to repay a portion of their students' defaulted loans. While I'm not against either of these ideas, both ideas are reactive instead of proactive because they only address defaulted loans that have already been issued instead of stopping the loans from being issued in the first place. I prefer the latter, which is why the things I'm proposing in this video should lead to less loans and less debt.